Option trading allows you to do a lot of things, whether it be leveraging your available money because you think a stock is going to run big, or making steady money off of just selling premiums from options. The options are almost endless, and you might find that you enjoy making consistent $50 to $100 a week rather than making $1,000 every couple months. There are a ton of methods to do this, like the wheel method, selling collars, or trading spreads. Welcome back to the channel. I'm Jacob Fisher, and today we are talking about option trading, specifically relating to spreads or verticals, as a lot of people call them. Options can be a little bit complicated, but trading spreads could potentially provide you with a bit of an income while limiting your overall losses. Let's go over what spreads are first and then get into some examples of spread trading. But I am not a financial advisor, so this video is for entertainment purposes only. And with that said, let's tap the like button and get into it. There are four main types of verticals that I will be getting into: the bull call, the bear call, the bull put, and the bear put. We'll be getting into each one in a specific example for each of them, but for the basics, you are anticipating a certain move in a specific direction with these spreads. The bull call and bull put are those for who are bullish on the stock overall, while the bear call and bear put are for those who are bearish on the stock or anticipated to go down. Let's first get into the bull options with the bull call. You'll be buying a call and selling a call in this situation, but the call you are selling, and this is the important bit, the call you are selling has to have a higher strike price than the one you are buying. Let's use NVIDIA in this example because why not? You can think NVIDIA is going to go up, but you are really trying to reduce the max possible loss you can take, looking at the 515 strike price calls and the 517.5 calls. We can set this up pretty easily. If you just bought the 515 calls, your max loss would be the price you paid, or $1,000, while your max gain, in theory, could be infinity, but you don't want your max loss to be high. I wouldn't either. What you can do though, with a margin account, is buy the 515 call, but also sell the 517.5 call, because again, the bull call vertical is you selling an option greater than the one you bought. This is an overall net credit, but the credit you're paying for this one is the max loss you can take. In this example, it's $120 to buy the call, giving you a max loss of $120, but a max profit of $130 with a 47% chance of success. The more in the money you go, the higher chance of success you have with a bull call, but you have lower profit and a higher max loss. Your max profit occurs when NVIDIA closes above 517.5 because at expiration, your bought call option will be worth $2.5 or $250, and your sold, the one you're short contract, would be worth $0. Any higher in price would increase both your bought call and sold call at the same value. So let's say NVIDIA ended up at 520. Your 515 call would be worth $5, or 520 minus 515, and your 517.5 call would be worth $2.50, but negative for you because you are short this. The max gain is the difference in strike price minus the amount you paid for it. So 517.5 minus 515 is $250 minus the $100 you paid for it, leaving you max gain at $130. Moving on, we have the bull put, which is you selling a put with a greater strike price than the one you buy. We can use the 515 put and the 517.5 put in this example. You are selling an option with a higher value than the one you are buying, so you can receive a debit or receive money. You're trying to profit off of the premium in the contracts. In this example, your max profit is again $130 because the difference in price and premiums of you buying is $130, with your max loss being $120 with a 46% chance of success. The more out of the money you go with this one, the higher chance of success you have with, of course, less max profit and higher max loss. Your max profit occurs when NVIDIA closes above 517.5 because you receive that debit from the options rather than purchasing the credit like the bull call. You are expecting all of the options you bought and sold to expire worthless because you received money already. You want the value of them to go to zero. That's hopefully the goal of them. Both of these methods though, you want the stock to go higher and are at least hoping it will continue higher so you can collect the money from the premiums. What if you want the stock to go down though? That's when we move into the bear call and bear put, which work in very similar ways. If the bull call is a credit and you're paying for that, then the bear put will also be a credit, while the bear call and the bull put will be debits and you will be receiving that money. For easy understanding, because a call is traditionally you thinking the stock is going to go up. The bull call, because bullish, you're bullish on the stock, and a call because you think it's going to go up. Both generally bullish things, you have to buy into that. While a bear put, a put is traditionally you think the stock is going to go down and you're bearish on it, same thing, so you have to buy into that one. While if it was reversed at a bear call, you would be receiving money instead and hoping to gain money off the premiums. And the same thing goes with a bull put. It just doesn't sound right, so you get money from it. Let's get into the bear put first because we'll just keep it going. You have to buy into that one again. You're buying into this. You have to buy an option with a greater strike price than the one you are selling. Your max loss is what you paid and the max gain is the difference in two strike prices minus what you paid for it. The bear put, you buy a 515 put and sell a 512.5 put, overall paying $1.10 or $110 with a max profit of $140 along with the chance of profit being 49%. Of course, the more in the money you go, the lower your profit, the higher your max loss, but higher chance of success occurs. Your max gain occurs when the stock drops below 515 or that put you sold. Moving on to the bear call, which is one where you receive the premium. You are buying a call with a greater strike price than the one you are selling. You would receive $120 in this situation with your max loss being about $130. You hope the stock drops below 515 at the time of expiration because you want the contracts to expire worthless. The more out of the money you go, the lower your profit, the higher your max loss, but higher chance of success occurs. Notice how all of these contracts are super similar, but at the same time, they're a little bit different with each of them. There are people out there who would rather receive the money because maybe the premiums are really expensive because maybe earnings are coming up than actually going out there and buying the contract. They'd rather just receive the money. Maybe it just makes sense. It depends on how the stock is doing that week and whether or not you should go for a credit or a debit. Let's say earnings are coming up and options are super expensive, then you might actually be able to profit more off of selling this options and receiving that premium, and maybe your max gain is going to be 2 times the size of your max loss because you're able to profit off of that. If the IV is low, but you think there's a chance it's going to increase that IV, which can boost up the price of options, consider buying the spread because all the option prices will be increasing in value despite them getting closer to expiration. How do you find these stocks to trade verticals on though? Well, you can come up with a strategic plan of using RSI, moving averages, volume, or potential news releases. You can also just keep an eye on maybe 10 or so stocks that you really like trading. If you notice patterns on those particular stocks, maybe you can go out there and try to use that to your advantage. Let's say you watch Tesla and you notice that no matter what, after earnings, it'll increase for the week. Then consider getting it a bull spread because you think it'll go up. You can also use various moving averages to decide if a stock has found support or lost support, or base your trades around that if you really want to. There's a million different ways to go about it, and in another video in the upcoming weeks, I'm going to talk about different programs that might be able to help you find these trades so you don't need to look around for them. Let me know your thoughts on trading verticals in the comments below. Also know that I upload videos on Monday, Wednesday, and Friday on travel and finance, so if that sounds like something interesting to you, make sure to hit that little subscribe button down there. Thank you so much for watching, and until next time.